Now we move into the strongest capital budgeting methods, and we'll apply the time value of money concept to capital budgeting decisions. The payback period and average rate of return methods do not consider time value of money. However, net present value index, and internal rate of return methods all incorporate discounting. These methods are preferred because they measure true economic value. Now we introduce net present value, or NPV. Net present value compares the present value of cash inflows to the amount invested. Cash inflows are discounted using what's called a hurdle rate, also called a required rate of return. If net present value is greater than zero, the project adds value and should be accepted. If net present value is below zero, the project does not meet the hurdle rate and should be rejected. Now let's look at an example of Galen Hoffler considering the purchase of a juice extractor for his business. The extractor costs $4,000 and produces annual cash inflows of $3,000 for 3 years. The hurdle rate is 20%. We discount each year's cash flow using present value factors. So in year 1, $3,000 is discounted by a factor of 0.833, bringing $3,000 back to today's dollars at time 0 of $2,499. The discount factor for year 2 is 0.694, which we multiply times $3,000 to arrive at a current value or present value of $2,082. We discount year 3 by a discount factor of 0.579 to arrive at a present value of $1,737. Tallying all those present values, we get $6,318 in today's dollars. We can compare that with the investment of $4,000 to arrive at our net present value, the difference between the total present values minus the investment. And that net present value is $2,318. Because the net present value is positive, the investment should be accepted. Now complete learning activity 8.6. The hydro massage bed costs $12,000 and generates $2,000 annual cash flow for 8 years. The hurdle rate is 10%. Compute the present value of the annuity using the present value of an ordinary annuity table. Pause here and work through the activity. Once you've finished, check your answers with the solutions provided in the back of Chapter 8. Now let's look at net present value with uneven cash flows. Sometimes investments generate different cash flows each year. In that case, we discount each cash flow separately using the present value factor for that year. Then we add the present values together and subtract the initial investment. Again, in this case, the net present value is positive, $1,810. That positive net present value means the project should be accepted. Now complete learning activity 8.7. This time, the hydro massage bed has uneven annual cash flows. You'll discount each year's cash flow individually using the present value of a dollar table. Then add the discounted cash flows together and subtract the initial investment. Pause here and work through the activity. Once you've finished, check your answers with the solutions provided in the back of Chapter 8. Now we introduce the present value index. The present value index is useful for ranking investment opportunities when capital is limited. Present value index equals the total present value of cash inflows divided by the amount invested. If the present value index is greater than 1, then the investment is profitable. If the present value index is less than 1, the investment does not meet required return. The higher the present value index, the better the investment relative to its size. If we look at the purchase of the juice extractor, if we take the net present value of $6,318 divided by the investment of $4,000, we get a present value index as 1.5795, which is positive, suggesting the investment meets the required return and is profitable. Now complete learning activity 8.8. The hydro massage bed costs $12,000 and has a present value of cash inflows of $12,199. The massage chair costs $8,990 and has a present value of cash inflows of $9,195. Compute the present value index for both investments and determine which has the higher return on investment. Now we move to the internal rate of return. Internal rate of return is the return that makes net present value equal to zero. In other words, it is the discount rate at which the present value of cash inflows equals the initial investment. If internal rate of return is greater than the required rate of return, accept the project. If internal rate of return is below the required rate of return, reject the project. To apply the internal rate of return method, we use the present value of an annuity table. Step 1 is to divide the amount invested by annual cash flow to get the annuity present value factor. Step 2 is to find the closest present value annuity factor on the table for the useful life. Step 3 is to identify the interest rate associated with that factor. That is the internal rate of return. Now let's recall the MC Aero's purchase of a Cessna 172 Skyhawk of a price of $280,000. It is expected to have an annual cash inflow of $56,000 for 10 years. Determine the present value of an ordinary annuity factor by dividing the amount invested by the annual cash flow. It results in a present value of an ordinary annuity factor of 5. Now find the interest rate associated with a period of 10 years and a factor of 5. The closest interest rate is 15%. That is your internal rate of return. Now complete learning activity 8.9. The massage chair costs $8,999 and produces annual cash flow of $2,745 for 5 years. Compute the present value annuity factor. Then locate the closest present value annuity factor on the table for 5 years. The associated interest rate is the internal rate of return. Pause here and work through the activity. Once you've finished, check your answers with the solutions provided in the back of Chapter 8.